Hello everyone, welcome to another episode of our Fund Manager series. Today we are going to discuss budget 2026-2027 and we have with us Mr. Ashwani Agarwalla from Edelweiss Mutual Fund.
Aditya,
Thank you Ashwani for joining us today.
my pleasure.
Ashwani comes with more than 20 years experience in fund management industry. He manages Edelweiss ELSS fund, FlexiCap fund, and he's also coming up with a new fund, banking and financial services. Thank you, Ashwani, for joining us today.
Thank you.
So, Ashwani, my first question: what was your overall takeaway from the budget yesterday?
I think the budget was really good within the scope of whatever it had, with your nominal GDP around about 10%. And if you see, there were no populist measures, and the government focused diligently on more efficient spending of the money rather than just putting money in the hands of the public. If you see, so they had more focus on Capex, which in infra, defense, railways, which was a very welcome move. But yeah, expectations were somewhat different. That's why the markets had a negative return yesterday because of slightly higher fiscal deficit, I guess.
Right. And so it was more of a structural budget than a populist budget. And when we talk about budget, it's always about fiscal deficit. And when we look at the target fiscal deficit, well in control of what was estimated last year. So how important is fiscal deficit with respect to a country, and what does it control?
So if you look at, for the last 5 years, if you look at the central fiscal deficit in 2021, if I remember, was more than 9%, roughly 9.2%. And it had come down substantially to roughly 4.4% this year in
Right.
FY25 budget. So having a fiscal discipline is very important, because if you don't have fiscal discipline, you run the risk of an international, you get international rating stability if you have a fiscal discipline. Inflation is under control, and the overall debt to GDP, where we are very much focused on, is under control. If you let your fiscal go haywire, then all these things, and including the currency, is impacted. So definitely this was a structural budget, as I said. They did not just dole out populist measures or gave away money in hands of the people. The money which is spent, or which is spent in form of Capex, has got a higher multiplier effect,
Right.
than just revenue expenditure. So definitely it was a structural budget. The focus continues to be on infra spending, Capex spending, which could increase by roughly 11.5%, despite lower tax buoyancy.
And since there is increased capex, so who all will be the beneficiaries, and what will be the long term effect of this, or the multiplier effect of this capex?
So clearly the beneficiaries in the yesterday's budget is first defense. The budget has been increased quite substantially as expected. Second would be railways. Even in railways, the growth is more than 10%. Highways, the only dampener was on water projects. The growth was little less than expected, or less than the overall growth. So in long term, a disciplined budget helps you in maintaining your fiscal discipline, as I said, or maintaining your borrowings, inflation, your currency, your debt overall. But it also gives the signal to the people that this government, or these policy makers, are not going to dole out free money. They will be strict to their discipline, and we have a glide path of roughly 50% to GDP by FY31, which we have adhered to.
Right. And one thing that people also need to understand, that the government is not thinking about short term, they are more thinking about
they're
medium
thinking
term
about-
and long term.
Yeah, more about job creation rather than just doling out populist measures right now. It is about creation of long-term wealth in the country.
Right. And now coming on to, since we are part of capital market industry, the reforms or the changes that have come through. One is definitely introducing a market framework for corporate bonds. What would be the impact of that market framework for bonds?
Right now, if you see, uh, the bond market in India is not very deep as compared to developed markets. So any corporate below the top notch rating or below AA plus have has to go to banks or NBFCs to get money. So as the corporate bond market develops, the banks will have more money to lend to the smaller corporates, SME category, and to the retail category. Currently, if you see, with our total gross borrowings at roughly 17.2 trillion, we may see some kind of a crowding out for corporates, and banks may face some problem in getting funds because the borrowing is in the higher side. Excuse me. So it's a welcome sign, or it's a welcome decision that they plan to deepen the corporate bond market,
Right.
and the reliance on banks uh, by the corporates will decrease. They will be able to access mutual funds, life insurance companies, financial institutions, and other bodies for loans.
And for any corporate, access to capital is very important, and that this market framework would certainly allow them.
Yes, really.
And now coming on to the one change that had a sentimental effect on the market yesterday, that was STT increase. So there was an STT increase on futures and options. Uh, so if what, and certainly not only there are speculative traders, but there are long term, like mutual funds also take futures and options for hedging. So what will be the impact of that change on any mutual fund?
So definitely for a mutual fund, the margin which they make will come down, and but if you see in the long term, it will adjust. People will adjust to the slight lower return, not really very dramatically lower return, slight lower return, but that's fine. Still, you will be getting more than a fixed deposit. But for retail investors, if you see, I don't think that it will be a really big problem because it will hardly impact their profitability by 2 or 3%. So
Right.
if you see, the government has done this thrice in the last few years, but it's more of a sentimental negative. And after a few weeks, people take it in the stride and move ahead. If I'm making money on F&O as a retail investor, I will not be bothered about 2 or 3% lower return which I get, right?
Sure. It was more of a sentimental.
Because if you see, the volumes in the F&O market has increased, and for last 2 years, SEBI has been trying to reduce the F&O activity. So
Right.
this was one of the steps which they pointed out as one of the steps to reduce F&O volumes, but it may be reduce the volumes for a few weeks or months, but it wouldn't be a game changer, I guess.
Sure. And just for the benefit of audience, when we talk about FNO, people always think about speculation. But how it is used by an institutional investor like a mutual fund, uh, what role does these derivatives play? If you can just explain for the benefit of the audience.
So, as an institutionals, we are not allowed to really have a open position in terms of F&O. In terms
Right.
of, I just cannot have a naked call or a naked put. So for us, it's more of a hedging
Hedging
instrument.
play.
But the retailers, they have used it in a naked position or as an open position.
Right.
So that's the difference between us.
I was just looking at, there's a category of arbitrage fund which have completely hedged futures positions, and they make the spread through that arbitrage spread. So uh, I believe there would be some impact on the transaction
Yeah,
cost.
there is some impact in the arbitrage funds,
Right.
uh, but that's not a big game changer.
Right.
But yes, people will adjust to it in a
Sure. Uh,
few months.
just looking in the morning, it was around 0.2 to 0.3%. The return would get effect
20 to 30 basis points, yeah, as you said
on an
correctly.
annualized basis. Right. And now coming on, you are coming up with banking and financial services fund. So, what's the thought process of coming up with the fund? and uh, how do you see the entire financial services sector playing out in India?
So the entire thought process was that especially the lending category, PSU banks or private banks, they have the best of the balance sheet in the last 15 years, whether in terms of capital adequacy ratio or if you look at the PL account, they have the best of the profitability. They are, most of the banks or the entire sector is sitting on an ROA of roughly 1.3%, and the gross NPIs are less than 2%, which we I think last saw in 2010-11. And for the last 5 years, from 2020 to 24, they have underperformed the broader markets. And the other sectors really outperformed because there was a huge fiscal stimulus from the side of the government. Now that has waned down. Now all these sectors are on their own. And if you look at 2025 was a turnaround year in terms of performance, where the BFSI category has overall really outperformed the 500 Nifty 500 by roughly 22%. So I think we are well poised for all the segments in the BFSI category, whether you see lenders, capital markets, insurance, and fintech players to grow for maybe 2 decades. Considering our demography, where 70% of the people are below the age of 35, they will require all the products of the from the financial market, from the financial services, starting from education loan to personal loan, housing loan, vehicle loans, business loans, saving, investments has just picked up in India in the last 10 to 12 years, if you see. And the new edge tech has made it easier to invest in the financial markets, in the capital markets. And people have made money in the last 10, 15 years in the capital markets. So earlier, most of our savings used to go, financial savings used to go in FDs or pension funds and
Sure.
savings account. So if you look at financial FDs, the fixed deposit, it takes roughly 14, 15 years to double your money. And now if we consider equity markets, just think that they will give you a 10% return or 10 to 12% return, 11, 12% return in the longer run. Then your money doubles in 6 to 7 years.
7 years, right.
So in an FD, if you double your money in 14 years, in an equity market, that money would be 4 times in the same period as compared to an FD.
Sure.
And people have really made good wealth using equity as an instrument. So we think there is a good 2 decade story or more in capital markets. And if you look at insurance industry, we are both under-penetrated and under-insured, both in life insurance and general insurance.
True.
And considering our demography, increase in per capita income, again, we are poised for a good, stable growth for the next 2 to 3 decades. And fintech is the new sector which has come up in the last 10 years. There are a lot of companies there with newer business models, very high growth companies, but it's still evolving category. So yeah, that sector is, or the companies there are not really very profitable, but we tend to hold names where we can see profitability or cash flows coming in.
Right. And so my last question on the equity market as a whole, and then equity market works in cycles where when we started 3 years back, and from 23 to 24 we had a phenomenal rally, and then from 24 till now it's more of a kind of a very volatile, range bound, flattish kind of journey. So how do you see at this moment the valuations in the equity market in India, and where do you see the next momentum or the push coming from?
First of all, we need to understand that what happened from 24 onwards, that our earnings growth came down or the markets really didn't perform. So whatever fiscal stimulus was given earlier was withdrawn gradually. The monetary stimulus was also withdrawn. The liquidity became negative. The interest rates increased, and the credit growth declined. In the last 8 to 10 months, all of them have reversed. The credit growth has again picked up. It's
Right.
from 9%, it has gone back to 13%. Liquidity is again positive to the tune of roughly 2 to 3 lakh crores. And but yeah, fiscal consolidation is still happening, but at a lower pace. We have come down from 9.2% fiscal deficit to currently 4.3%. From here onwards, the fiscal consolidation, which will be much slower than what happened in the last 4 years. So if you see, the earnings growth should pick up from FY27 onwards, and then we would see the market tracking the earnings growth. If you look at the valuations are at par with the average of last 5 years. But if you look at the 10 to 15 year valuations, we may be slightly higher than the average. What has happened, as I think that a lot of money has chased the same 500 stocks or 700 stocks in the last 6 to 7 years. That's why the overall valuation looks to be slightly expensive than the average. But in the last 2 years, a lot of froth has been removed from the markets. But yes, we are not still cheap, as I say.
And thank you so much, Ashwini, for
Thanks, Aditya.
for all the budget insights as well as all the market insights. And we look forward to doing more such sessions with you and your fund house. Thank you so much.
Thanks a lot.
Thank you.